Welcome to Performance Optimization Strategy Basic. Myself, Srijit Kakkar. For more information on our products and courses, you can visit www.srijitkakkar.com. Before moving ahead, please make sure you go through the disclosure. I will keep it on the screen for some time. Performance Optimization Strategy Basic Part 4. In this lesson, we will cover entry types, boosters, exits, and trade management. Let's understand different ways to enter a trade. We will be learning 3 different ways to enter a trade based on the quality of the trade setup. The first kind of entry is called as type 1 or limit entry. Let's take an example of supply zone. The proximal line is at 200, which means I want to go short when prices reach 200. As a type 1 trader, we will place a short order in advance. As soon as the price reaches the proximal line, the order will get executed. Similarly, in case of demand zone, the proximal line is at 100, which means I want to go long when the prices they reach 100. As a type 1 trader, we will place a long order in advance. As soon as the prices reach the proximal line, this order will get executed. The second kind of entry is called as type 2 or zone entry. In case of supply, we wait for the prices to enter the zone and form a bearish or a very bearish candle. Once we see this bearish signal inside the zone, we can immediately go short at the current market price. In case of demand, we wait for the prices to enter the zone and form a bullish or a very bullish candle. Once we see this bullish signal in the zone, we can immediately go long at the current market price. The third kind of entry is called as type 3 or confirmation entry. In case of supply, we place short order at the proximal line after the formation of bearish or very bearish candle. The short order will get executed as soon as the price leaves the zone. In case of demand, we place long order at the proximal line after the formation of bullish or very bullish candle. The long order will get executed as soon as the price leaves the zone. As we move ahead in the course, we will learn how to identify bullish, very bullish, neutral, bearish, very bearish candles for type 2, type 3 trades. Let's understand the advantages and disadvantages of different kind of entries. We will take example of demand zone. The same will hold true for supply zone. In type 1 or limit entry, since our orders are placed in advance, type 1 entry has the highest probability of meeting the entry as prices can just touch the zone and move away. And because the orders are placed in advance, type 1 entries can also be done as set and forget. Talking about the disadvantages, in case of type 2 entry, we wait for the prices to go inside the zone and form a bullish or a very bullish candle. This implies that we are buying at a price which is cheaper than the proximal line. Therefore, in case of type 2 trades, the risk will be smaller compared to type 1 trades. So the first disadvantage of type 1 entry is it has higher risk compared to zone entry. If you look at the target, type 1 entry will have smaller reward compared to type 2 entry. And since we are not waiting for any bullish or bearish signals in case of type 1 entries, it also has the greatest unknown, which increases the probability of stopping out. For type 2 entry, we wait for the prices to enter the zone and form a bullish or a very bullish candle inside the zone. Once we see the bullish or very bullish candle, we immediately buy at the current market price. Since we are buying cheaper than the proximal line, the risk on the trade reduces. This is why type 2 or zone entry has the lowest risk of all the entry types. Since we are buying at a cheaper price, the reward on the trade increases, which is why type 2 entries have the highest reward of all entry types. In case of type 3 entry, we place our order at the proximal line after the formation of bullish or very bullish candle. Since price can gap beyond our entry price, type 2 has higher probability of meeting the entry compared to type 3. Many times prices can react immediately from our demand zones without forming a bullish or a very bullish candle inside of the zone. This is why type 2 entry has lower probability of fill, because we have to wait for the bullish or the very bullish candle inside of the zone. Type 2 entries cannot be automated. For type 3 entries, we wait for the prices to enter the zone and form a bullish or a very bullish candle inside of the zone. Once we see the bullish or very bullish candle, we place an order to buy at the proximal line when prices are leaving the zone. Since we are buying at proximal line, the risk is same as limit entry. Likewise, the reward is same as limit entry. Since we are waiting for a double confirmation, bullish or very bullish candle inside of the zone and price leaving the zone, type 3 entries have less probability of stopping out. Many times prices can just touch the zone and move away, or after forming a bullish or a very bullish candle, gap beyond the zone. This is why confirmation entries have the lowest probability of getting the fill. Because we have to wait for the bullish or the very bullish candle, confirmation entries cannot be automated. Boosters provide us the edge. Booster is a scoring system that objectively measures the quality of a trade setup. We focus on trading when a specific criteria occurs on price chart, providing a significant advantage. We use boosters to help us measure that advantage. Boosters will also help us plan trades mechanically and therefore act consistently. You will decide which score to be accepted to enter a trade based on your level of risk aversion and your experience. The more boosters used, the better the understanding of the trade setup. We will cover 4 boosters in Performance Optimization Strategy Basic and additional 6 boosters in Performance Optimization Strategy Advanced. The first booster is Freshness. Let's assume on a price chart, price starts moving down. The logical reason for prices to move down has to be more supply. Since the prices are getting cheap, let us assume that somebody starts buying 50 lakh shares at this price level, due to which price starts trading in a range. Let's assume that the supply gets depleted and because of more demand, price starts moving up. There is a possibility that the person who wanted to buy 50 lakh shares did not get a 100% fill. Let's assume he only got 20 lakh shares and still has a pending order of 30 lakh shares. This price movement on the chart will create a drop base rally demand zone pattern. After some time, price again starts coming back into the zone where we already have a pending order of 30 lakh shares. Price again starts trading in a range. Let's assume this time 20 lakh more shares get filled. Due to more demand, price again starts moving up, which means that at this price level, we still have a balance of 10 lakh shares to be bought. After some time, price starts coming back into the zone where we already have a pending order for 10 lakh shares. Price again starts trading in a range and now the balance is 0 shares to be bought. Since the demand has been depleted because of more supply, now prices can move down. What we understand from this example is that if a zone is fresh, it can have pending orders. But the more number of times a zone is getting tested, with each test the quantity of pending orders can decrease or deplete. This is why freshness is the very first quality booster. If the zone is fresh, it can have pending orders. Therefore, a fresh zone will get a score of 3. If a zone has been tested once but a shallow touch, we will give it a score of 1.5. And if a zone has been tested multiple times, we will give it a score of 0. Second booster is strength. On the chart, you will see that some candles are very big while others are not. Let's try to understand the reason behind that. Markets are made up of buyers and sellers. Buyers are bidding the price at which they want to buy, and the sellers are asking the price at which they want to sell. If you look at the table on the right, on the bid side, we have a buyer at 99.95 willing to buy 102 shares. Then we have a buyer at 99.9 willing to buy 54 shares. Similarly, we have a buyer at 99.85 willing to buy 205 shares, and a buyer at 99.80 willing to buy 7 shares. On the ask side, we have a seller at 100.05 willing to sell 2 shares. Then we have a seller at 100.1 willing to sell 305 shares, a seller at 100.15 willing to sell 45 shares, and a seller at 100.20 willing to sell 84 shares. If the current market price is 100 and I want to buy, I can only buy from a seller, and the first seller is available at 100.05. The maximum number of shares I can buy from the seller is 2. If I place an order to buy 2000 shares at 100.05, I will only get 2 shares because that is the quantity available at 100.05. Therefore, if I want to buy more shares, I will have to increase my buy price, or in other words, have to buy expensive. If I buy 10 paise expensive from the current market price, I can get 2 plus 305, which is 307 shares. If I buy 15 paise expensive from the current market price, I can get 2 plus 305 plus 45, which is 352 shares. If I buy 20 paise expensive from the current market price, I can get 2 plus 305 plus 45 plus 84, which is 436 shares. The more expensive I buy, bigger the quantity I can get. Therefore, for 2000 shares, I might have to buy 50 paise expensive from the current market price. Similarly, if I want to sell 2500 shares, by selling 5 paise cheap, I can only sell 102 shares. If I sell 10 paise cheap, I can sell 102 plus 54, which is 156. If I sell 15 paise cheap, I can sell 361 shares. If I sell 20 paise cheap, I can sell 368 shares. The cheaper I sell, the bigger the quantity I can get. Therefore, for 2500 shares, I might have to sell 40 paise cheaper than the current market price. This example tells us that for bigger quantities, we will have to buy at expensive price or sell cheaper than the current market price. That is why when we see strong moves on the chart, they tell us that somebody started selling at cheaper price or somebody started buying at an expensive price for a bigger fill, which can only be the big boys. This is how strength helps us identify the footprints of areas where big boys were buying or selling. Strength is our second quality booster. If the leg out is a gap or an explosive move, we will give it a score of 2. If the leg out is strong, we will give it a score of 1. And if the leg out is weak, we will give it a score of 0. Third quality booster is time spent at the level. If big boys were participating, because their orders are huge orders, the other side should quickly get absorbed and price should not remain in that area for a long period of time. Therefore, to apply this booster, we count the number of candles in the basing. If the number of candles is from 1 to 3, which means prices spent very little time in the zone, we will give it a score of 2. If the number of candles in the basing is from 4 to 6, we will give it a score of 1. And if the number of candles in the basing is more than 6, we will give it a score of 0. The last quality booster is reward to risk ratio. To apply this booster, we will identify how far is the opposing fresh zone. This booster helps in two ways. One, it helps us understand the reward to risk ratio before we enter the trade, which is a very important part of our trade plan. Since we understand that every trade cannot be profitable, we only want to participate in trades where our reward to risk ratios are good. And two, the only time we will be having good reward to risk ratio is when the retracement to our zone is strong. This strong move helps us identify the emotion of fear and greed. For an overnight trade, if the reward to risk ratio is greater than or equal to 3:1, or for an intraday trade the reward to risk ratio is greater than or equal to 2:1, we will give it a score of 3. For an overnight trade, if the reward to risk ratio is greater than or equal to 2:1, or for an intraday trade, if the reward to risk ratio is greater than or equal to 1.5:1, we will give it a score of 1.5. For an overnight trade, if the reward to risk ratio is less than 2:1, or for an intraday trade, if the reward to risk ratio is less than 1.5:1, we will give it a score of 0. A zone can have a maximum score of 3 for freshness, 2 for strength, 2 for time at the zone, and 3 for reward to risk ratio. Therefore, the highest quality score of a zone can be 10. As a trader, we should always trade the best zones. Therefore, if the quality score of a zone is from 0 to 7, we will not trade the zone. If the quality score is 8 or 9, we can trade it as a type 2 or a type 3 trade. If the quality scoring is 10, we can take it as a type 1 trade. Let's look at an example. On the chart, we have a drop-based drop supply zone. Let's apply the quality boosters. The zone is fresh, therefore we'll get a score of 3. I have applied explosive move indicator. All black color candles are explosive candles. Since the leg out is explosive, therefore a score of 2. Number of candles in basing is 1, therefore a score of 2. When the price is coming back to the zone, we will identify the opposing fresh zone for target. In this case, it's a rally base rally. Now we will find the reward to risk ratio. Since it is more than 2:1, it will be a score of 3. Therefore, the total quality score for the zone is 10. Here, you can see that after hitting the supply zone, price moved to our target. After entering a trade, we also need to close the trade by exiting it. Exit can be in profit or loss. Loss exit is called as a stop loss and profit exit is called as target. When planning exits, make sure you have a clear and pre-planned target and stop loss. The targets should provide you applicable reward to risk ratios. For intraday trades, we need a minimum reward to risk ratio of 2:1, and for overnight trades, we need a minimum reward to risk ratio of 3:1. Target exit will be before opposing fresh zone. If you are going long at demand, the opposing zone for target will be supply. If you are going short at supply, the opposing zone for target will be demand. Stop loss will be the distal line. In zoning rules, we talked about using body to wick method as the preferred method for entries. For targets, we will be using wick to wick method. After entering a trade, we need to follow trade management rules for managing risk. Every trade has 3 components: entry, trade management, and exit. Proper trade management strategy is key to profitable trading. Proper trade management means having preset rules-based methodology for adjusting stop loss to protect capital even before the trade is entered. Break-even means entering and exiting the trade at the same price, or in other words, no profit, no loss. Our break-even rule will be revise stop loss to entry at 1:1. Let's look at an example of trade management using demand zone. In this trade, entry price is 100 and stop loss is 98. We are waiting for prices to come back to demand zone. Once the price retraces to the demand zone, we will be entering the trade at 100. Our stop loss is at 98. Therefore, we are taking a risk of 2 rupee on this trade. Once the price moves the same amount in our favor, we will be at 1:1, which means our profit is equal to our risk. At this time, we will revise our stop loss order, which was at 98, to our entry price 100. If the price keeps moving up, we can achieve our target, but in case the price starts moving down, we will be exiting the trade with no profit, no loss, and this is called as a break-even trade. Let's look at an example of trade management using supply zone. In this trade, entry price is 200 and stop loss is 202. We are waiting for price to come back to supply zone. Once the price retraces to the supply zone, we will be entering the trade at 200. Our stop loss is at 202. Therefore, we are taking a risk of 2 rupees on this trade. Once the price moves the same amount in our favor, we will be at 1:1, which means our profit is equal to our risk. At this time, we will revise our stop loss order, which was at 202, to our entry price 200. If the price keeps moving down, we can achieve our target, but in case the price starts moving up, we will be exiting the trade with no profit, no loss, and this is called as a break-even trade. Trailing stop loss is a protective stop that follows price. It can be based on point values or a percentage, which is automatic in most platforms. As we move to performance optimization strategy advance, we will be learning a trade management strategy which will be based on demand and supply zones. We call it as technical trailing stop loss and will be applied manually. This is Surjit Kakkar signing off. See you in the next lesson.